All right, welcome to episode 9 of the Knoxville Financial Q&A Show. I'm your host, Paul.
And I'm Brian.
And today we're going to talk about the biggest retirement mistakes that we see most often.
Number one, I'd say, is taking Social Security too early. I'd say most people just aren't aware of like provisional income and some of the things that come along with taking Social Security. And so, like, I would say that ends up being the number one. And if you don't know what provisional income is, you can look it up. But the biggest factor is just what's the only sources of money that you can take from to avoid that. So if you get this idea where you're like, all right, I'm going to retire at 61 or 62, and I'm going to start, I'm going to work part-time, and I'm going to start taking Social Security. Well, the problem is you could have 50 all the way up to 85% of your Social Security taxed. But the only sources that you can pull money from and live on, so during that time frame and avoid that, are Roth IRAs, HSAs, but the caveat to that is it has to be through qualified medical expenses, which means you would have to have a pretty decent chunk saved up in an HSA. You would also have to save all your medical expenses and all your Advil and everything that you've purchased over the decade or more, and then you start taking that money in retirement to try to avoid that. So there's not a lot of places. That's the number one mistake I think I see.
Okay, and I think another issue there is if you take it at 62, you're stuck with whatever that income is at 62, and your cost of living adjustment is going to be based off of that.
Next to nothing.
Right. So instead of waiting for a little while where if you're getting more down the road, your cost of living adjustment could be a little bit higher versus taking it at 62.
I would say longevity risk, when you start to think about it too, that's something to take into consideration. If you have, family history of like heart disease and most of your family is not living past 65, don't wait.
Right. There's no point in waiting if there's a really high possibility of you not living that long.
So some of it, I think, is just kind of like, this goes back to what we've said every single time we do this. It's situational based. It's like, what does your situation look like? But I still think that's a pretty common mistake.
If you've ever taken a life insurance exam, what they ask is, are your parents still living? If not, what age did they pass away? If the life insurance companies are using that as a way of determining your life expectancy, we kind of use that also in planning. It's not always correct, obviously.
No.
But it matters. And
hey, if some underwriter is looking at an actuarial table, factoring that as a decision making, it's got to be important in some capacity.
Yeah, and another issue with taking it too early is, as we were just talking about, let's say you are healthy, but you pass away anyway, right? And your surviving spouse, then is getting a reduced benefit instead of getting a higher benefit.
Yep.
Yeah, if you just waited to take it a little bit longer. I think right now, full retirement age is 67 if you were born in 1960 and later, right? And I think if you wait from 67 to 70, it increases by 8% per year. So you got 3 years of an 8% increase. And if you can wait till 70, not everybody can, but if you can, because people are living longer, that's a pretty significant jump.
It is.
Yeah. So I guess from like a financial advisor standpoint, it makes sense to tell our clients to take it early if there's a health situation, a life expectancy situation, or you just flat out need it because you have to meet living expenses.
Yep. Yeah, haven't saved enough money. So what would you say the next one is?
Oh, it's too much cash, I would say. We see that quite often, actually. We've actually seen it more since 2008 when they basically got burned.
Yeah, I got scared.
Right? And they never got back in the market, and they just figured, let's just save some cash, maybe in a high-yield savings account or something like that, which back then wasn't really high yield. Now it's okay, but it's still not keeping up with inflation.
Right.
Right? But the biggest factor here, in my opinion, is opportunity cost. Right? The money is it's not participating in market growth.
Yeah, you look at what the market's done in the last year and a half, 2 years, and yeah, if you just had cash sitting on the sidelines at 4%, you lost big time. I mean, double digits. Cash is the opportunity cost, as you said. Cash is constantly eroding what it can buy. We see that every day in our life. Gas and everything else fluctuates, but we see that everywhere. And so if your money is not earning whatever it costs, that inflation erosion is just dramatic.
It's massive.
But then the next part of that, I think, too, is I think most people don't really understand that even when you come down to like CDs, or if it is earning small, it still counts towards provisional income, like our first mistake that we're talking about. And I think so, like, playing it safe, sitting there, you're losing your purchasing power, and you decide to take Social Security, it's now counting towards your provisional income.
I know when I build a portfolio, I typically only hold 1% to 2% cash in there, and that's mostly to cover fees or expenses or something like that.
Yeah.
But you're paying us to manage money, not manage cash.
Yeah.
So 1% to 2%. Of course, have an emergency fund first and foremost, right? That's fine.
Always.
No problems there, but don't let your money just not work for you when it can be.
And that's not just a retirement mistake. That's a everybody mistake. I mean, you figure my general rule of thumb is always imagine your worst 24-hour period, and you should have that cash on hand. Everything beyond that needs to be invested in some capacity. It's just, I mean, that's a big mistake, period.
I agree. So I guess the final point on this is have an emergency fund. If you have a large purchase that you're going to be making coming up, maybe keep that cash on hand so you don't have to liquidate anything, maybe get some short-term or long-term capital gains. That's fine. But for the most part, let your money work for you and invest it.
Yeah.
So Brian, what's the next one we have on the list?
Next one I would say is no tax strategy. I'd say where I see this kind of come into play most of the times is people come to me and they've pulled money for a purchase, whether it was small or to pay off debts or to help out kids, grandkids, some other capacity. They pull cash because they needed it, and then they don't realize that it came with either, in some cases, let's say they're, 55 or 56. Not only did they get early withdrawal, penalties, then they got hit with taxes. And it may bump them up a tax bracket. But I think from the retirement perspective, it's just people don't realize that most of the money that you can access still comes with taxes in some capacity. So they think, okay, well, I've had this money sit in a CD, and if they've deferred it, or maybe an annuity, maybe they just had like a fixed indexed annuity or a fixed annuity, and they had this deferred tax consequence. Or places that we see whole life insurance. We see these people that were sold a whole life policy, and I say sold because that's exactly what it is.
Yep.
They were sold this policy. Oh, well, we can touch it, we can use it, we can borrow from it. Well, then when they have a loan to pay back, they go to retire and they go, I don't really want to pay a loan back. So they go to cancel their policy, and it's like, oh, by the way, deferred taxes. So I'd say this just comes down to planning, but I'd say like having no tax strategy. They don't know where to pick money from. They don't know how to get the money, correctly. Like they don't realize that you can do first in and first out or last in, first out. It's a reporting nightmare, but there is ways to maximize withdrawing money. And I think most people just aren't aware of it.
Yeah, I would say you're exactly right. I think what you just said, withdrawing from the wrong accounts at the wrong time in retirement can certainly increase your tax bill. Another thing I would like to add to that would be, and we've said it probably in, I would say, 4 of the 8 videos we've done so far, is asset location matters.
Yep.
Right? Make sure your assets are in the most invested in the most tax efficient manner possible.
Yeah. Is there anything else you want to add to that?
Yeah, I would say what happens if you pass away and you haven't planned properly and all this money goes to your beneficiaries in a non-tax efficient manner. That happens if it's not planned correctly.
For sure.
Mm-hmm.
All right, what's the next one on the list?
So the next one is required minimum distributions, RMDs.
Mm-hmm.
So RMDs themselves aren't necessarily the problem. Not planning for them is definitely the problem. So I think a lot of people don't even realize the effect that the RMDs can have on the amount of taxes that they're going to be paying. And we talked about this again before, like the gap years when you just retired, but you're before age 73 and you're probably in a low income tax bracket at that point. That's normally a good time to either do Roth conversions or even if it's not a Roth conversion, just do an IRA withdrawal or a 401k.
Taking the money and using it.
Yeah. But most people don't realize like they can be bumped up into a higher tax bracket when the RMDs are forced upon you basically at age 73.
For sure.
Right. And currently, and this is general, but I think like if you're 73, your first withdrawal is about 3.8%, something like that, or the first RMD of your qualified portfolio. That could be a significant amount. So if you got $1 million portfolio, there's an extra $38,000 added to your income.
And that works its way up if I'm not mistaken, they heavily weight it for about 5, 6, 7 years. So it kind of ramps up,
Yeah.
peaks, and then kind of does the trailing back off.
Yeah.
So it's kind of like a bell curve.
Yeah.
And so that matters too, because I think, you may, if you get caught blindsided by year one, imagine what year 2, 3, 4, and 5 are going to look like, and it's not fun. And then, yes, it starts tapering down, but you're still above
I think at like age 85, it's at 6 point something percent.
Yeah, somewhere in the, I was going to say, I think it ramps up to almost 10%, if I'm
could,
not mistaken.
yeah.
I want to say, I think it obviously depends on how much money you have. They kind of weight it for that. But yeah, it could be a big, oh crap.
Yeah, the government's getting their money whether you like it or not, and whether you need it or not as income, it's coming out of your account one way or another.
I think something that's probably not talked about in our profession enough is inheritance. As my generation sees like the baby boomers start to like die off. I mean, imagine if I'm 60 years old and get hit with an inheritance, and I have thanks to the Secure Act, yay, I have this 10 years to distribute this money, and let's say that it's a substantial amount of money, $1 million, $2 million, $3 million, and now I have to withdraw it within 10 years. I mean, I'm facing that with a client right now, is, like right up at that window of getting close to retirement, and now I have a 10-year window to withdraw almost $2 million in cash. It's a challenge. And then you start to think about, okay, well, now if I earn money or turn on Social Security, like all these little problems start clicking and adding up, and you didn't even plan for it. And so even if you plan well, you could get hit with oh crap, now what?
And unfortunately, like we've seen it where people are required to take the RMDs and the market is doing horrible.
Oh yeah.
Right? And that's like a worst case scenario.
Yep.
But it happens. So you can plan, the best way to plan around that is to reduce the RMDs by as much as possible before you have to take them. All right, Brian, what's the last one on the list?
The last mistake I think I see the most often is not updating beneficiaries. Something I try to do with every client. If they've got like 1 or 2 accounts and no life insurance, it's not it. But I have a worksheet that I do with them called the Beneficiary Audit Worksheet, and I make them audit their beneficiaries. So the 401ks, IRAs, the life insurance policies, everything. Because I think most people don't understand is you can have a well-sorted will and say, I've got a will. If you didn't change the beneficiary trumps the will. Ex-wives happen to start getting claim to 401ks or life insurance or an old IRA or whatever, even though the will states that the new current family is supposed to get it. So yeah, I see that and that can be not necessarily retirement, that can be just a financial mistake that is made very often.
Yeah. So like Brian said, even if you think you have a really rock solid will, if you have beneficiaries listed on the accounts as someone else that's aside from the will, they're getting the money.
Yep.
Regardless of what the will says. And I think a lot of people don't actually realize that. So I think another mistake is naming minor children as a beneficiary. That could lead to legal complications where when they get the money is determined at a state level. And so whenever we have clients that come in and want to name their minor children as beneficiaries. We try to bring in an estate planning attorney whenever possible.
All the way down to like your individual accounts, because we were talking about beneficiaries. I think most people don't realize like their taxable individual investment account can have what they call a TOD designation or transfer on death. That matters too.
Yeah.
I think that's an oversight that often gets overlooked, and really is important. I mean,
yeah, I mean, it's super easy to open an individual account. They don't ask for beneficiaries or anything on the forms. And so those accounts, they just don't have any beneficiaries. That could lead to big problems down the road if you pass away.
Unless you have a trust or a will that sets up a trust.
Right.
Is there anything else you can think of to add to the beneficiary?
Yeah, I mean, I guess like when should beneficiaries be reviewed? As Brian mentioned before, we have a pretty solid form that can help us with that. And we try to at least do that once per year when we meet with our clients. But especially after a marriage or a divorce, after birth of a child or even a grandchild, really.
Yep.
After the death of one of the beneficiaries that you already had named. I think those are all important times, obviously, when
Getting married.
Getting married.
All right. So as we wrap this up, is there anything else you want to add?
Yeah, I mean, I think going back to the first thing that we talked about, there's a ton of YouTube videos that talks about when to take SSI. And, I don't necessarily agree with any of them. A lot of them seem to be when to take it. So you say, okay, take it at age 62 and you'll earn this much throughout your retirement period before you die, whatever. It's like a one-size-fits-all solution. And they'll bring up charts and they'll show you all this other kind of stuff. That's for one particular person.
Yep.
Right? Everybody is different. Everybody has a different situation. And I can't understand how you can recommend this is the exact age when you need to take it without actually knowing the client or the person or their situation or anything else like that. It just doesn't make any sense to me. Some of those guys obviously aren't securities licensed. Otherwise, they wouldn't be able to say it.
Yep.
Some of them are. And some of them just have faith in whatever that system is that they believe in. That's fine. The way Brian and I do it, it's per client.
Everybody's different.
Everybody's different. So I just wanted to throw that in at the end. And I guess we can wrap this one up.
Yeah.
So with that said,
Signing off.
signing off.